Yeah, so last time we were looking at a question for cash flow statement. So at least I was able to see some of you are able to try to come up with the cash flow statement, but you are missing out just on a few areas. So I want us in this case immediately, we try and actually look at that cash flow statement, how you could have actually been able to present it. Then I think now we can be able to start on topic number 5 today. So the question was in this case from December 2022, question number 5. December 2022, question number 5. So in this case, you have 𝗲𝗡 Limited, 𝗲𝗡 Limited, 𝗲𝗡 Limited, statement of 𝗲𝗡 Limited cash flow statement for the year ended, cash flow statement. For the year ended, 31st of October. I think it is 31st of October. 30th of April, is it 30th of April or was it October? Was it April or October? It is 30th of April 2022. As at 30th, for the year ended 30th of April, for the year ended 30th of April 2022. So you can, in this case, our shillings are actually in thousands, so you can be able to indicate here shillings in thousands. So in this case, we start with the cash flows from operating activities. 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 In this case, we start with profit before tax. Profit before tax. So the profit before tax that in this case we've been provided for with, it is actually 8190. Is it 8190? The profit before tax. The profit before tax is how much? Yes, it is 8190. It is 8190. 8190. Then in this case you can adjust for you can be able to adjust for the non-cash items. In this case, you can be able to adjust for in this case non-cash items and the finance cost, we can adjust for. So in this case, we had actually done some calculations, and in this case we had the depreciation. So we in this case had the depreciation of, in this case, an amount of 700 and in this case was like 5490 depreciation. We have depreciation. So 5490, this one we add back. We also have amortization. We have amortization. This depreciation is as per note number 3. Note number 3. This one is as per note number 4. Note number 4. In this case is an amount of 540. 540. We also had in this case gain on disposal. So in this case you have the gain on disposal. Gain on disposal. Gain on disposal. So it was in our working. We did a working and we got a gain was 345. So this one we deduct 345. So we'll end up having to deduct. Also, we have in this case what so you have depreciation, amortization, gain on disposal. Then also you have in this case the government grant income. So this government grant income was not a real inflow of cash. So in this case, it's just a grant the government had actually provided the people to give this entity. But now the real cash flow that is what in this case we calculated and we got as 1710. So this government grant, will actually end up having to deduct it, which is in this case an amount of 705 or 750. 750. So we'll end up having to deduct it. Then in this case, we have to add back, in this case, what are the finance costs? We have to add back, in this case, the finance cost there, which in this case is an amount of 705. In this case is an amount of, in this case, 705. So 705. So in there, we'll be able to get the cash flows before the working capital changes. So in this case, we'll be able to have the cash flows before the working capital changes. But now we can just be able to continue that. So in this case, you have depreciation, amortization, gain on disposal. All these workings we have done. Government grant, you'll add it back because it's not a real inflow of cash. What we got as a real inflow of cash is what we calculated under, I think, the last working, which was coming to 1710. So this one, you likely end up having to add it back here. Also, in this case, the finance cost. Then now, in this case, we can be able to consider the working capital item changes. In this case, we can be able to consider the working capital item changes. Working capital item changes. So the working capital item changes, we can be able to consider them. So we have in this case trade receivables, we have in this case inventory, and we have in this case trade payables. So in this case, for the inventory, they were having to increase. For the inventory, they were having to increase. And also for the receivables, they were having in this case to do what, to increase. So in this case, we'll deduct both of them. So in this case, we have increase in inventory. Increase in inventory. We have in this case a figure of inventory is how much? 13,300, right? 13,300 minus 11,445. Also, we have an increase in the trade receivables. In the trade receivables. So for the trade receivables, there was an increase from 7080 to 9230. So 9230 minus 7080. So 9230 minus 7080. Then for the trade payables, there was also in this case what, an increase. For the trade payables, there was in this case what, an increase, and therefore in this case, this one will likely end up having to, we'll add it. So add the increase in trade payables. So we'll be able to add the increase in trade payables. So there's an increase in trade payables. So trade payables, there was also an increase. So trade payables, there was an increase from, in this case, an amount of, so trade payables, in this case, we have, so 10,200, 10,200 minus 7770. So for the increase in the inventory, you get a figure of, in this case, 1855 and 2150. So 1855 and 2150. So both of them in this case will end up having to deduct. We'll deduct the increase in the current assets, while the increase in the current liability, the trade payables, will likely end up having to add is an amount of 2430. Is an amount of 2430. So you'll be able to get a total here. Then now we can be able to consider the tax paid. The tax paid, and in this case also the finance costs. The finance cost, there was in this case no any form of adjustment, so you'll just end up having to pick this figure. So it is 705. So you'll be able to deduct there 705. For the tax paid, we had calculated, and I think we were getting 1635. You are getting 1635. So both of them you deduct. So what is the figure you're getting here? There's a figure you're getting here before. In this case, we can be able to deduct those ones. So what is the figure you're getting there after you've been able to consider the working capital? You need to add from here. You need to work out these, and in this case, this. There's a figure you should be able to get here. There's a figure you should be able to get there. It is 8190. Felista, what is the figure you're getting there before you consider the finance cost and the tax paid? Before you consider the finance cost and the tax paid, there's a figure you're getting there. 13,755. Another person can be able to confirm. Yes, I can see you're saying 13,755. 13,755. And so you're saying 13,755. Another one is saying 11 to 20. So which is which? 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 11,205. Everyone seems to be getting his own figure. So which one? Are you saying this one or this one here? Eleven to 20 and 11,205. 11 to 20 and 11,205. So let me confirm with my calculator. Let me confirm. Let me confirm. Let me confirm. So we have 8190 plus 5490 plus 540 minus 345. So this one is 13,755. Then we can be able to minus so we can in this case minus 1635. Then in this case we can minus 705. So you get 11,415. So 11,400 correct. It is correct. It is correct. It is so that is this 13,755. So 13,755 minus 1635 minus 705. You get 11,415. I think it is 11,415. Yes, I can see you're saying 11,415. 11,415. 11,450. So you can put say this one are what cash flows? Cash flows from net cash flows from, in this case, what? Net cash flows from operating, net cash flows from the operating activities, net cash flows from the operating activities. So net cash flows from the operating activities. Then in this case, you can be able to go to the cash flows from the investing activities. Cash flow from, in this case, what? The investing activities. Cash flows from the investing activities. So cash flows from investing activities. You can have cash flows from investing activities. So from the investing activities, I think there was a disposal of an asset. So in this case, you can be able to have disposal of an asset. We have disposal of an asset, which was in this case sold. So they got some proceeds from there. So on the disposal of an asset, in this case, they got some proceeds from there. It was in this case 1810. So I think it was 1810. 1810. Then there was an acquisition of the assets, acquisition of assets. I think you are getting 11,455. 11,455. Then we have acquisition of intangible assets. Acquisition of intangible assets of intangible assets. So the acquisition of intangible assets, simply think it was having to come to 1140. It was coming to 1140. So I think with these ones, so these ones were acquisitions, so we deduct. Those ones were acquisitions, so you'll be able to get the net cash flows. You'll get the net cash flows from investing activities, the net cash flows from investing activities, the net cash flows from the investing activities, the net cash flows from the investing activities. You'll be able to get the net cash flows from the investing activities. You can add that one. You can add that one. You can add that one. On the government grant, are we supposed to add or deduct? So the government grant, we are supposed to deduct. Did we deduct? Did we deduct? Did we deduct? We're supposed to deduct, or we didn't? Have we deducted? We're supposed to deduct. On the government grant, we are supposed to deduct. We are supposed to deduct. So the government grant, we are supposed to deduct. Have we deducted or we've added? We've added. Oh, we've added. We are supposed to deduct. The government grant, you are supposed to deduct. You're supposed to deduct. So it doesn't represent a real inflow of income. And then in this case, you're supposed to deduct. So we are supposed to deduct the government grant. We had added. So it is supposed to be 8190. 8190 plus. So let's confirm that figure, plus 705 plus 5490 plus 540 minus 345 minus 750 then minus 1855 minus 2150 plus 2430. We are supposed to have deducted the government grant. Sorry about that. You're supposed to have deducted the government grants. So as I was having to say, it doesn't represent a real inflow of income. And therefore, in this case, you're supposed to, in this case, do what? Deduct it. So you need to deduct it. They will get another figure here. That's why I was having to wonder, why are we having to get a very funny figure? So you need to correct here. We need to correct. So here it will come to what? The government grant you're supposed to deduct. So they, in this case, recognize it as an income in the income statement. But in this case, I'm having to say, it doesn't represent a real inflow of cash. It had increased the income. The profit before tax, it had increased it. So you're supposed to deduct it. Then now we'll be able to recognize the real inflow of 1710 under the financing activities. So when you correct this figure will end up having to change. You get what? So you can change that. The government grant you deduct. You don't add it. We had added. You actually deduct. It doesn't represent a real inflow of cash. So we deduct it. But now the real inflow will basically be included in the 1710 we had actually calculated. That's what you'll be able to recognize as an inflow. So you'll get a figure of when you correct this one. When you correct this one, you need to correct this one here. Just correct it. So the government grant will deduct. That 750 you're going to deduct it. So we don't add. So exactly, if you put a bracket, then in this case you deduct. Oh, I've already wrapped my figures, but now you can be able to put a bracket and in this case do what? Deduct. So it will come to what? You need to be able to correct this one. This figure here. This figure here. So for this one, you are getting 1810 plus, I can see you're saying 1990. You can see you're saying 9915. So it is 12,255. 12,255. So this one will come to 12. It will come to 12,255. It will come to 12,255. Then you need to correct this one. When you correct this one, so when you correct this one, it is coming to 9915. So it will come to 9915. It will come to 9915. What about this one? So 1810 plus 11 minus 11,455 minus 1140. So 1810 minus 11,455 minus 1140. You're getting 10,665. So 10,665. So 10,665. So these are our parts B. This is our part B, which in this case is negative. It is negative. It is negative 10,665. So that is our part B. That is our part B. So those are the net cash flows from, in this case, what the investing activities. There are only 3 items under what the investing activities. It is 10,785. So 10,785. You can see you're correcting me. 10,785. 10,785. 10,785. 10,785. So you can, in this case, go down, in this case, to cash flows from financing activities. Cash flows from financing activities. From financing. Cash flows from financing activities. So on the cash flows from financing activities, we, in this case, have the government grant. So cash flow from government, we have the government grants. Government grant. Now the government grant comes here as an inflow. That's why we are deducting there. So the government grant in this case is now 1710. So this is now the inflow you'll be able to recognize. So because in this case that 750 we have in this case been able to use it to calculate this one in the government grant account. So what was received in terms of cash for the government grant, the real cash, it was this amount, not that income. That income they have just been able to recognize it in the books, but they are yet to receive it. It was for this particular financial year. But what they received as real cash was actually 1710. This one is basically covering probably the amount they had been promised last year. And in this case, they're having to get what? 1710. Then the other item in this case is what? The shares. So the sale of shares. The sale of shares. Remember, there was in this case what? Some shares which in this case were sold. Some shares which in this case were sold. So some shares which were sold. So on the ordinary share capital, we got an amount of, in this case, what? 900. So we have in this case ordinary share capital. So we got an amount of, in this case, what? 900. We had in this case share premium. Share premium, we got an amount of, in this case, what? 900. So for the ordinary share capital, you can look at the accounts here directly prepared. There are those figures you'll be able to see. There's 900 and 900. Then for the dividends paid, for the dividends paid, we have dividends paid. Dividends paid, there's a figure we got. We prepared a retained earnings account. I think we prepared a retained earnings account. There's a figure we got for the dividends paid. Dividends paid, we were getting how much? 3450. We were getting 3450. We were getting 3450. In this case, we were getting 3450. Then in this case, you have the loan notes. The loan note. So on the loan notes, in this case, remember, of course, they directly in this case given out loan notes of what? 3 million. But now they didn't receive the entire amount. They only received how much? 1.2 million. So they only received in this case how much? 1.2 million. They only received 1.2 million. So this one was an outflow. So we deduct. For the loan notes, they only received 1.2 million. So because if you look at the loan notes at the start of the period up to the end of the period, it is increasing by 3 million. But remember, out of these loan notes, as per note number 1, 1,800 was in this case paid, or in this case was given by having to give an asset. And therefore, the 3 million minus 1,800, you'll be able to get what? This amount here. You'll be able to get this amount. So in this case, basically, it is 3 million minus 1,800. So you'll be able to get the amount they received as the real cash in terms of what? A cash inflow on the loan notes, as a cash inflow on the loan notes. So with these items, then in this case, you should actually be able to get the cash flows from, in this case, what? The net cash flows from, the net cash flows from financing activities, from financing, the net cash flows from, in this case, what? Financing activities, the net cash flows from financing activities, the net cash flows from financing activities. So there's a figure you'll be able to get. So 1710 plus 1,800 minus 34 plus 1,200. Plus 1,200. So that gain on property, don't recognize it. You've already recognized it in the PPE account. Don't put it here. Don't put it here. We've already recognized it in the PPE account. So that gain, don't recognize it here. We've already been able to recognize it in the PP account, So it is coming to 1260. So 1260, in this case, I can still say 1260 or 1260. So that it is positive. So that is our part C. 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 So in this case, you can get the total cash and cash equivalents. So the cash and cash equivalents for the year. So the cash and cash equivalents, total cash and cash equivalents. The total cash and cash equivalents, in this case, you'll be able to take A plus B plus C. So you'll take, in this case, the three figures, you add them. So there's a figure you'll be able to get here. When you take the three figures, so 10,785 negative plus that, plus the one we got in the other one, you are getting what? When you add the three figures. So A plus B plus C. A plus B plus C. 99, 15 plus 10,785. You get 390. Can see you're saying 390. 390. When this 390, you take the opening figure for cash. It is 510. The opening figure for cash is 510. So add on the opening. Add on, in this case, the opening cash and cash equivalents. Cash and cash. Add the opening cash and cash equivalents. You can add on the opening cash and cash equivalents is an amount of 510. An amount of 510, and therefore with that, you in this case end up having to get the closing cash and cash equivalents. You get the closing cash and cash equivalents, or in this case, an amount of 900, because that's how you could have actually been able to present it. You could have actually been able to present it. So that's the end of it. That's the end of it. So I think we can finish copying. We can actually finish copying because now we want to move to another area. So we're going to move to topic number 5. So we're going to move to topic number 5. Now I want us to start on topic number 5. Topic number 5. So you can write this topic number 5. So topic 5. Topic 5, you can write consolidated financial statements. Or sometimes this only referred to it as group accounts. accounts. This one we refer to it as group accounts. So there are a number of standards that are applicable here. It is not only one, there are a number of them that in this case are actually applicable here. So under this topic, majorly what we're going to look at it is how you can be able to prepare what we call group accounts. So ideally, what is group accounts? Group accounts will arise in a situation where we have a company that in this case has actually acquired what we call subsidiaries. So you can have in this case company A. So maybe it can be 𝗕𝗟𝗢𝗓. It can be 𝗕𝗟𝗢𝗓. So 𝗕𝗟𝗢𝗓 has been able to make acquisition of shares in a number of companies. So in this case, it has acquisitions in a number of companies. It can be able to control the affairs of a number of companies. We can have maybe the two rivers. The two rivers, we can have in this case 𝗕𝗟𝗢𝗓 Bank, 𝗕𝗟𝗢𝗓 Bank, amongst others, 𝗕𝗟𝗢𝗓 Bank, amongst others. So you realize that this 𝗕𝗟𝗢𝗓, 𝗕𝗟𝗢𝗓, in this case, if it is a company, we say it is a person, it is a legal person. So you must have been told that in your company law, you must have been told that in your company law, there is a legal person that can be able to own shares in these other companies. So you might find that in this case, probably, this 𝗕𝗟𝗢𝗓 as a company, 𝗕𝗟𝗢𝗓 Limited as a company, it has a control of, let's say, assuming 90% of this 𝗕𝗟𝗢𝗓 Bank, 90% of this 𝗕𝗟𝗢𝗓 Bank, and maybe this one, two rivers, they are having to, in this case, they have actually made an acquisition of shares of, in this case, what maybe 30%, or what in this case, maybe in this case, what 30%. So maybe there can be another one. Maybe in this case, it can be, let's say, for example, 𝗕𝗟𝗢𝗓𝗓. So in 𝗕𝗟𝗢𝗓𝗓, this 𝗕𝗟𝗢𝗓, as in this case, as shares in this case, what in this case, let's say, for example, maybe 10%, it is actually controlling, or in this case, it's not controlling, but ideally in this case, it has an acquisition of shares of, in this case, what 10% in 𝗕𝗟𝗢𝗓𝗓. So all these ones, basically, in this case, they end up having to form what we call a group. They form a group. And therefore, in this case, what you realize it is that 𝗕𝗟𝗢𝗓 as a company, they prepare their own financial statements. They prepare their own individual financial statements. And in this case, you're having to say the income statement, they prepare their own statement of financial position, their cash flow statements, they prepare them independently. Same case with these other companies. They also do the same. So this one has its own management, so they also prepare their own financials. This one has its management, they prepare their own financials. This one has its management, they prepare their own financials. This one has its management, they prepare their own financials. So if in this case it happens, there's this kind of a situation, this company you're calling 𝗕𝗟𝗢𝗓 will in this case be called upon to prepare in this case what we call group accounts, or in this case what we call consolidated financial statements. To consolidate is to bring together, is to combine. To consolidate is to do what? To combine. So what is supposed to happen in this kind of a situation, we are supposed to take the financial statements of all these entities. Remember, this one has its own income statement. Each and every entity here, they have their own income statement, statement of financial position, their own cash flow statement, their own statement of changes in equity. So in this case, what happens under group accounts or consolidation will in this case ideally take all the income statements of all these four companies and come up with a single income statement. We'll come up with a single income statement. When we do that, we'll be able to come up with what we call a consolidated income statement. So Macquarie, in this case, this one has its own income statement. This one has its own. This one has its own. This one has its own. So it is a requirement that this 𝗕𝗟𝗢𝗓 Limited or 𝗕𝗟𝗢𝗓 Group, they should be able to, in this case, prepare a single income statement. So in this case, do what we call consolidation, and in this case, be able to come up with a single income statement from the individual income statements. Same case with the statement of financial position. So every company here has its own statement of financial position. But now in this case, you have to do what? We have to, in this case, do what? Come up with a single statement of financial position, which we call consolidated. So that aspect of, in this case, combining all the income statements, all the statement of financial positions of members of a group. In this case, we call it consolidation. And ideally, that's what in this case you're going to learn in this area we're calling group accounts or consolidated financial statements. Take note that in this case, there has to be in this case a significant influence, or there has to be in this case maybe a control. So in this case, you can see there are three companies here. So remember, in this case, 𝗕𝗟𝗢𝗢𝗓 is having, in this case, in this case, has an ownership of shares worth 90% in what? CDR. So this CDR becomes what we call a subsidiary. So for subsidiaries, it means in this case, the holding company, this one we call it the holding company. The one that in this case is able to control or has a significant influence in other companies, we call it the holding company. It is the holding company because it has acquired shares in these other companies. It has acquired shares in these other companies. And therefore, if it is having, in this case, an ownership stake of more than 50%, up to, in this case, 100%. So that other entity, in this case, we call it what? A subsidiary. See, the ownership stake is actually 50% plus. So like this one, now CDR becomes a subsidiary to 𝗕𝗟𝗢𝗢𝗓. If in this case, the ownership stake, in this case, is actually in this case, what? 20% up to 49%. This one, we call it in this case what? An associate. So this one becomes an associate. This is to reverse because it is 30%. It is in between here. It becomes an associate. Well, in this case, if it is below 20%, it becomes, in this case, what? A simple investment. It's just a simple investment, not a serious one. It's not even a significant influencer. So in this case, if it is more than 20%, it's a significant influence. If in this case, it goes up to 49% ownership stake in that other company, the Two Rivers, for example, here, becomes what we call what? An associate. But in this case, it is less than 20%. This Transcenture, in this case, becomes what? Just a simple investment. It becomes just a simple investment. If it happens, it is 50-50%. Maybe in this case, remember in this case for the subsidiary, being able to say it is 50% plus. So it means it is 50 point something plus, it becomes a subsidiary. But in this case, if it is 50% exactly, so that other company becomes a joint venture. And therefore, we'll be looking at, in this case, if there is such, for example, in this case, what? Entities having to operate together in a group, how do we end up having to come up with a single income statement and a single statement of what? Financial position. So we'll be able to look at how you account for subsidiaries, how you account for associates, and in this case, how you account for what? For joint ventures. How you account for joint ventures in a group. Therefore, before we go to the real mathematics of things, we need to be able to understand a number of things here. And therefore, I want you to be able to write a number of things here, and you have to be very keen. Just from this moment, I can tell you, you need to be very alert. Never ignore anything we are going to say from this moment in this topic. You have to be very keen at what you're having to say and try to comprehend what are we having to say. So you can, in this case, start with the definition of a number of terms. We can start with definition of terms. Definition of terms. So the first term in this case, I want us in this case to be able to define is in this case what we refer to as what? Consolidation or business combination. So number one, we can define this consolidation or business combination. What is consolidation or business combination? Consolidation or business combination. So you can be able to write this about this consolidation or business combination. Consolidation or business combination. So Stephen, what is a joint venture? 50-50%. If it is actually 50-50% ownership stake, then that becomes what? A joint venture. The other company becomes a joint venture. So what is the consolidation, or in this case, what? Business combination. So you write this. It refers to bringing together. Of separate entities. It refers to bringing together of separate entities. Into a single reporting entity. Into a single reporting entity. It refers to bringing together It refers to bringing together of separate entities into a single reporting entity. Into a single reporting entity. Into a single reporting entity. Full stop. It brings about, full stop, then you write, it will bring about, or in this case, it brings about the parent, it brings about the parent, and it brings about the parent and, into bracket, subsidiary, associate, into bracket, subsidiary, associate, or joint venture, relationship. It brings about the parent and subsidiary, put in brackets because there are a number of them, into brackets, subsidiary, associate, or joint venture relationship. So in this case, the parent company here was what? 𝗕𝗟𝗢𝗖𝗞. Our subsidiary was in this case what? 𝗕𝗟𝗢𝗜𝗢 Bank, because it's more than 50% up to 100. Our associate was in this case what? 𝗕𝗟𝗢𝗓𝗓, because this parent company has an ownership stake or shares in this one worth more than, in this case, what? 20% up to 49%. If in this case it is 50% exactly, so that other company becomes, in this case, what? A joint venture. That other company becomes a joint venture. So it becomes a joint venture. So this is basically what you are trying to combine the books of accounts of all these entities. You put them together and you come up with what? A single income statement. You come up with a single statement of financial position, or maybe in this case, what? A cash flow statement. So there are a number of terms you've been able to mention here. So number 2, you can in this case write subsidiary. What is a subsidiary? You can write subsidiary. You can just write subsidiary, and we try to define what is a subsidiary. You can write this about a subsidiary. You can be able to write this about a subsidiary. It is an entity that is controlled by another entity. It is an entity that is controlled by another entity. It is an entity that is controlled by another entity. It is an entity that is controlled by another entity, i.e., the parent company. It is an entity that is controlled by another entity, i.e., the parent company, It is an entity that is controlled by another entity, i.e., the parent company or holding company. The parent company or holding company, full stop, or holding company, full stop. The control is typically established when the parent company, owns more than 50%, of the shares of the subsidiary. More than 50% owns more than 50% of the shares of the subsidiary. The control is typically established when the parent company owns more than 50% of the shares of the subsidiary. Then number 3, you can be able to write an associate. you can be able to write an associate. An associate. Number 3, you can be able to write an associate. So what is an associate? You can be able to try and actually define what is an associate. You can write an associate. It is a company. It is a company. It is a company. It is a company. It is a company in which another company has acquired. It is a company in which another company has acquired. It is a company in which another company has acquired. In which another company has acquired. It is a company in which another company has acquired. In which another company has acquired. 20% has acquired 20%. 20% to 49%. 20% to 49% has acquired 20% to 49% of the shares. 20% to 49% of the shares. %20 to 49% of the shares. 20% to 49% of the shares. So a company in which, in this case, another company has acquired an ownership stake of 20% to 49% of the shares, that kind of a company, we call it what? An associate. We call it 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 an associate. Then in this case, number 4, you can be able to write joint venture. Joint venture. You can be able to write joint venture. Number 4, you can be able to write joint venture. Number 4, joint venture. Number 4, you can be able to write joint venture. It is a company in which 50% is a company in which 50%. It is a company in which 50% of the shares. It is a company in which 50% of the shares have been acquired by another company. It is a company in which 50% of the shares have been acquired by another company. It is a company in which 50% of the shares have been acquired. It is a company in which 50% of the shares have been acquired by another company. By another company. %50 of the shares have been acquired by another company. Have been acquired by another company. Full stop. It is also known as a joint arrangement. 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 So we can say joint venture, we can also say joint arrangement. So remember, in this case, you know, when you talk about a subsidiary, more than 50%. So you need to underline in the subsidiary definition, underline that more than 50%. Underline that what? More than 50%. But in this case, when you talk about a joint venture, it is 50%. Exactly 50%. In a subsidiary, it is more than 50%. In a joint venture, it is exactly 50%. Exactly 50%, it brings about what? A joint arrangement. Or in this case, it brings about what? A joint venture. That other company now that has been acquired in shares will be referred to as a joint venture. It will be referred to as a joint venture. It will be referred to as a joint venture. So another term that in this case we can be able to define, number 5, another term that we can be able to define, consolidated financial statements. Consolidated financial statements. Consolidated financial statements. So we can be able to also define what is consolidated financial statements. So you write this. These are financial statements. These are financial statements. These are financial statements of members of a group. These are financial statements of members of a group. These are financial statements of members of a group presented as a single entity. These are financial statements of members of a group. These are financial statements of members of a group presented as a single entity. Presented as a single entity. These are financial statements of members of a group presented as a single entity. 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 So there's a new term that has come there, so you can be able to write number 6, group. What do you, in this case, do you mean by group? What do you mean by in this case group? When you say group, what do you mean by in this case what group? You can in this case try to define that group. So in this case, you can be able to write group. Group. This comprises of. This comprises of the parent or the holding company. This comprises of the parent or the holding company. This comprises of the parent or the holding company and the other members, i.e., this comprises of the parent or the holding company and the other members, and the other members. This comprises of the parent or the holding company and the other members, i.e., subsidiary, joint venture, joint venturer, and in this case, what may be associates. So the other members plus the holding company, they form in this case what? A group. They in this case form a group. So how will you know the parent company? It is the one that has acquired 50%. It is the one that in this case has acquired 50%. The parent company is the one that in this case has actually been able to acquire in the other one 50%. So it becomes the parent company. In all the situations, the one that has acquired is what we call the parent company. In all the situations, the one that has acquired in the other one is what we call the parent company. And therefore, if it is a subsidiary, it is controlling the affairs of the subsidiary. If it is an associate, then it has acquired between 30 to 49%, 20 to 49%. If in this case, a joint venture, it has acquired 50%. The one that has acquired 50% is the parent. Is the parent company. So there in this case, I want us in this case, we look at now in this case what we refer to as what group structures. So you can in this case have a number of group structures. So you can in this case look at the different kind of group structures we can be able to have. So those terms will actually be delving deeper into them as we just go by. But you just have to be able to understand that's what you mean by those particular terms. We look at how you prepare financial statements. So we have a joint venture, how you prepare financial statements. So we have in this case a subsidiary, how you prepare financial statements. So we have an associate. So in this case, be looking at as to how you account for them. So you can in this case write a small title here, group structures. And this is ideally what you're supposed to always be able to start with when you're solving a consolidated financial statement in an exam. You need to start with drawing what you call a group structure. You need to draw a group structure. You need to draw in this case what? A group structure. So in this case, you can put right. There are three main types of group structures. There are three main types main types of group structures. There are three main types of group structures. There are three main types of group structures. So number one, horizontal structure. Number one, you write horizontal structure. Number one, you write horizontal structure. Number one, you write horizontal structure. And you will in this case write something about horizontal structure. Then in this case, you'll be able to draw it using how it looks like. You write this about horizontal structure. It is where the parent acquires controlling in one or more companies. It is where the parent company acquires control in one or more companies. It is where the parent company acquires control in one or more companies. It is where the parent acquires. It is where the parent acquires. It is where the parent company acquires control in one or more companies. In one or more companies. In one or more companies. So in this case, it looks like this. It looks like this. It looks like this. So we can be able to draw it. It looks like this. It will end up having to look like this. It is horizontal. It is horizontal. So in this case, we have A, which is the parent company. So A is the parent, or we call it the parent or holding company. The parent of the holding company. You can have B, C, D. So in this case, in B, maybe it has acquired 70% of the shares. In this one, it has acquired 60% of the shares. 60% of the shares. In this one, it has acquired maybe 65% of the shares. 65% of the shares. And therefore, it has control in all the companies. You can see how the structure is having to look. It is going horizontal. It's going horizontal. In this case, having to go at horizontal. If it acquires another company, they'll put here. So if it acquires another one, they'll add here. So it would have, in this case, a stake or an ownership stake in all the companies. So they'll actually be going, they are the same level. All of them be subsidiaries. They are just at the same level. So in this case, it will end up having to create what? A horizontal structure. It will create a horizontal structure. Then number two, vertical structure. You can be able to write number two, vertical structure. Number two, vertical structure. So vertical structure. Number two, vertical structure. Whenever in this case you're trying to solve a question for group accounts, you always start by having to draw the structure. The structure in this case will be able to guide you. For example, in this case, how you now be able to deal with what? The consolidation now. How you'll be able to prepare the financials. This is the first thing. You draw a group structure. You need to draw the group structure as the instructions are being given in the question. So we can be able to have what we call a horizontal structure. You can be told in the question, the parent company acquired 2 subsidiaries. So like that. Then in this case, this one was 70, this one was 60. So if there are 2 of them, it will end up having to be the same level. And now in this case, it will be able to create what? A horizontal structure. It goes horizontally like this. Then you can have a vertical structure. A vertical structure. You can be able to write this about a vertical structure. Write this about a vertical structure. Write this about a vertical structure. This one is 70%, 60%, 65%. Those are the percentages. All of them are subsidiaries. They're all of them subsidiaries. The percentages give you all of them to be subsidiaries. So it is bringing about what? A horizontal structure. So like that. It has an ownership stake where the parent company acquires control in 1 or more companies. So it is a horizontal structure. Does the structure give you a mark? It won't give you a mark, but I can tell you, you will see why it is important. You wait till we start doing questions. You'll see why it is important. It doesn't give you a mark, but once you start solving questions, it is when now you'll see why I'm having to tell you it is very important. You know how the structure is having to look like. For now, you might not be able to see it because we haven't even tackled a question. But always, when you're doing a question, start with drawing the structure. You will see when you start doing questions, you'll see why is Mwalim saying we draw the structure first. you'll see the essence of drawing the structure or understanding how is the structure having to flow. But for now, you just understand that is a horizontal structure. But now we can also be able to have what we call a vertical structure. A vertical structure. Don't start confusing yourself. In this case, when you start having to say it doesn't add to 100%, the more you think deep, the more in this case you continue confusing yourself. It doesn't add to 100%. You just understand what I've said here. So long as the company is controlling affairs of other companies, and now in this case, maybe the 70%, this one is 60, this one is 65, then that other company becomes, that basically brings about what? A horizontal structure. It doesn't add to 100%. It can even be an associate. There's no problem. It can even be an associate. So in this case, he has acquired an associate that you can be able to put here. Maybe they have an associate. Maybe you can be able to say E. Maybe this one, they have in this case, what, 30%. So there's no problem. So it can still basically be what even an associate having to be there. So long as now in this case, you can see it is in different. Let's do the vertical, then you see the difference. Let's do the vertical, then you see the difference. Huh? You see the difference with the horizontal one. So right, this is about a vertical structure. Right, this is about a vertical structure. This occurs where a parent acquires a controlling interest in a subsidiary. This occurs where a parent acquires a controlling interest in a subsidiary. A controlling interest in a subsidiary. And the subsidiary acquires a controlling interest in another company. So we've been able to write that. This occurs where a parent company acquires a controlling interest in a subsidiary, and the subsidiary acquires a controlling interest in another company. Hope you've been able to write that statement. This occurs where a parent company acquires a controlling interest in a subsidiary, and the subsidiary acquires a controlling interest in another company. Acquires a controlling interest in another company. And therefore, this one will look like this. This one will look like this. The vertical one goes vertical. It goes vertical. It goes vertical. So you're having to say the vertical one in this case goes vertical. It goes vertical. So in this case, you have what? A. It acquires a controlling interest in B. So this one could be 80%. Then now this B, the subsidiary, acquires a controlling interest in another company C. So another company C. So this one could be 90%. So you can see what is happening there. You can see what is happening there. So you can see this one has acquired in B. The share 80% of the shares in B. Now B has acquired 90% of the shares in C. You can see it is going vertical. Maybe this one can also acquire another one. Maybe D. It's going vertical. It is going vertical like that. It is going vertical. It is going down. So it's not having to go horizontal like this. So it is going vertical. This one acquires in this. And in this case, this one has also having to acquire in this. So it will basically bring about what? A vertical structure. It will bring about a vertical structure. So what in this case you likely end up having to realize is that so as interest, you can write as interest, or maybe other than having to say interest, you can say as control in B is 80%. As control in B is actually 80%. So this is the first thing you should be able to write there. Just besides the structure, just besides you can write that. Then another thing that is very important, as control in C, how do we get it? This you have to be keen as what I'm saying here. Listen to what I'm going to do here. See what I'm going to do here. As control in C. Remember, C, this one has not directly acquired in C, but still it has a control in. So as control in C is equals to 80% multiplied by 90% is equals to 72%. Is equal to 72%. So you can see this one indirectly still controls this one. By the fact that in this case, they already have an ownership stake here, it is still having to control this one. How do you get the control? This times this, you'll get 72%. 72%. So in this case, that is basically what is having to happen there. What is in this case having to happen there? What is 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 having to happen there? So in this case, that is what is having to happen there. It is going vertically. It is going vertically like this. Vertically like this. Then number 3 structure is what we call a mixed structure. Mixed structure. So a mixed structure is just mixed. It's just jumbled up. It's just jumbled up. It is just mixed. So you have in this case what a mixed structure. A mixed structure, right? This is about a mixed structure. It occurs where a parent company acquires. It occurs where a parent company acquires a controlling interest in a subsidiary. Acquires a controlling interest in a subsidiary. And then the subsidiary, it occurs where a parent company acquires a controlling interest. A controlling interest in a subsidiary. And then the subsidiary together. And then the subsidiary together. It occurs where a parent acquires a controlling interest in a subsidiary, and then the subsidiary together with the parent, and then the subsidiary together with the parent acquire an interest in another company. So it occurs where a parent acquires a controlling interest in a subsidiary, and then the subsidiary together with the parent acquire an interest in another company. Acquire an interest in another company. It occurs where a parent company acquires a controlling interest in a subsidiary, and then the subsidiary together with the parent acquire an interest in another company. So therefore, this will likely end up having to look like this. You'll have A, B, then C. So basically what is happening is like this, likely like this. So this one is the parent. This one is the parent, ndio mzazi. This is the parent, ndio mzazi. So mzazi ameacquire 80% of B. So 80% is the subsidiary. Then this parent together with this one, they get another interest in another company, C. Maybe this one can be 30%. This one can maybe be 40%. So you can see both of them have acquired an interest in C. So this one initially acquired this, but now both of them have acquired an interest in what? In C. So to bring about what? A mixed structure. It is mixed. It is just jumbled up there. So you can see this one together with this one, together with the subsidiary they acquire in another company, both of them together. This one 30%, this one 40%, this one 40%, this one 30%, and this other one what? 40%. So in this case, for us to be able to get, in this case, get what? The interest of A in C. So we can be able to get the interest of A in C. So we can be able to get the interest or control of A in C. So in this case, the interest of control, the interest or control of A in C is equals to, in this case, we'll have the direct interest. So the interest of A in C, this one, the interest of A in C, because this one is already direct, is 80%. But now the interest of A in C, the direct interest is actually 30%. You can see it is 30% here. But now the indirect interest will actually be 80%. You multiply by 80%, you multiply by 40%. So it actually end up having to come to what? 32. It is 32, so it will come to 32%. So in this case, it will come to 32%. And then in this case, in total, it is actually 62%. So the interest in A in C is actually in this case of 62%. The direct one is the 30%. But now the indirect one, it goes like this. So 80% by this, so you'll be able to get 32. The total of the two comes to 62%. It comes to 62%. It comes to 62%. I can be able to see Ruth was having to say pardon. So I don't know what I'm pardoning. What am I supposed to pardon, Ruth? About interest control. The interest of control. Administrator. So what do you want me to explain exactly about the interest and control? I'm unmuting you to ask the question. So hopefully you've been able to see. So that is the interest or control in C. So you take the direct interest first of all, which in this case is 30%. Then you add on the indirect one. You add on the indirect, you take the indirect. This one is indirect, it's not direct. They go through this B. It is indirect. This one is indirect. The direct one is this one. The indirect one is this one. Then you add, you get 62%. 62%. But this one is not common in the exams. You don't even have to worry about it. The one that is common is the horizontal one. The horizontal one is very common. But the vertical and this one mixed, this one is not your level. This one is not your level. You will majorly learn about them. You will do the real questions about them in advanced financial reporting. But the ones in this case will majorly deal with in the questions you're going to do in the past papers is the horizontal one. The horizontal one. So the vertical, those are for advanced financial reporting. So it means what you are learning here is very important. Never ignore this topic. You will still get it in advanced financial reporting. So the far much you better understand or grasp it here, the better. So don't ignore it. Don't ignore it. You'll basically build up on it. So it will become more complicated as you go by. So in this case, what you're just doing here is just a foundation. It's just a foundation. So it means in this case, what a better understanding as you move forward. So that's basically in this case what the interest or control of A in C. That's how you get it. But of course, it is not in the past paper questions. So what you eventually get is the first one, the horizontal one. So there's in this case, one of the definitions in this case I actually forgot in this case to indicate. So you can be able to write somewhere NB. After the group structures, write somewhere NB. And you write in this case non-controlling interest. I forgot to put under the definition of the different terms, write non-controlling interest. You write non-controlling interest as an NB, write non-controlling interest. Then you define this non-controlling interest like this. You define this non-controlling interest like this. Non-controlling interest like this. This is the proportion of the net assets in the subsidiary. This is the proportion of the net assets in the subsidiary. This is the proportion of the net assets in the subsidiary. This is the proportion of the net assets in the subsidiary. This is the proportion of the net assets in the subsidiary that is not owned by the parent or holding company. This is the proportion of the net assets. This is the proportion. This is the proportion of the net assets of the net assets in the subsidiary. This is the proportion of the net assets in the subsidiary. This is the proportion of the net assets in the subsidiary. That is not owned by the parent or holding company. That is not owned by the parent or the holding company. That is not owned by the parent or the holding company. By the parent or the holding company. So this is the proportion of the net assets in the subsidiary that is not owned by the parent or the holding company So like in this case, here it means the non-controlling interest here is actually 38%. This is what it means. So you can be able to even write here NCI 38%. So when you add the NCI plus the control, you will get in this case the total, which is actually 100%. So that's that other part that is not acquired, we call it the NCI. We call it in this case what? The NCI, the non-controlling interest. So what in this case, what that statement means, this one is very important. It is one of the key computations we'll likely be calculating. So you must get it from the onset here. So what do you mean by that? For example, if it happens that we have in this case what? A parent company. We have a parent company that has acquired in this case a subsidiary B. And of course, we've already been able to define a subsidiary. Is where in this case what? The percentage of ownership or stake is more than 50%. And then in this case, we should be talking about maybe 70%. 70%. So here the control is actually what? 70%. The non-controlling interest is 30%. And therefore, in total, we should be able to get what? 100%. So it means this parent company is only controlling 70% of the net assets. 70% of the net assets. 70% of what? Of the net assets. And in this case, when you talk about net assets, this is basically what? The equity part of the company. For example, in this case, if I ask you, how do you get the net assets? How do you end up having to get the net assets? It is normally the equity part. It's normally in this case what? The equity part. So in this case, we say net assets. Net assets is equals to what? So I hope you've drawn this because it will help you remember this. Have you drawn? Jen, you should have already been able to draw this. So if you have under just that under NCI definition, A, B, then in this case, this one has acquired 70%. This one has acquired 70% of the shares or the equity of, in this case, B. Then the control of A in B is actually 70%. But now, what they are not able to control is the non-controlling interest, which is in this case the remaining 30% of the net assets. Which is the remaining 30% of what? Of the net assets. So this one, 70% of the net assets is what they're able to control. 30% of the net assets is not what they are not able to control. So these ones we normally call them the minority. So we used to call it minority interest previously, but now in this case, we normally refer to it as the non-controlling interest. They are minority because they are not beyond 50%. They are minority in this case because they are not beyond 50%. They cannot be able to control. I think your company law lecturer must have told you. That voting or controlling the affairs of the company is based on the number of shares you hold in the company. So the more percentage in terms of the shares you have, you are able to control. That's why you are calling it control. You are able to control because you can vote and decide as the majority owner of the shares in that company. You have a bigger say. You can be able to control because you have more percentage in terms of the net assets of the company. But those who are remaining, they are not able to control. They are the non-controlling. They can't control. Single-handedly, they cannot, in this case, for example, decide upon what? The matters of that what? Subsidiary. You are the bazoo of that other company because you have the bigger percentage. You are controlling. But the ones who are holding the two remaining shares of 30%, the 30% of the remaining shares, they are the non-controlling. The NCI. They are the NCI. And there's something you're having to mention here, net assets. What in this case you have to get from the onset and be able to understand. When you talk about an acquisition, ideally in this case, we are acquiring into, like in this case, what? The ordinary share capital, the preference share capital. We are acquiring into, in this case, what? The equity part. And then in this case, when you talk about the net assets, the net assets in this case, net assets, as of course you already know in this case, is normally equal to what in this case? The total assets minus total liabilities. Which ideally in this case is the equity part. Of the statement of financial position. So you talk about total assets minus total liabilities. Because in this case, how do you present in this case what? The balance sheet. We say non-current assets, then we say current assets, we close. Then in this case, we end up having to say equity. Then we say non-current liabilities, then we say current liabilities, then we close. So they should be able to balance. So if we take these ones, we minus these ones, we remain with this. So this is the equity, the net assets. These are the net assets that are acquired into by what? The parent company. So when you take these ones, we minus total liabilities, total assets, minus total, you remind the equity part of the statement of financial position. And therefore, in this case, what is being acquired into is, for example, when you talk about the equity part, is ordinary share capital, the revaluation reserves, the share premium. Those are the equity portions of, in this case, what? The retained earnings. That's what is being acquired into. This 70% is what they are acquiring into. Those equity, the equity part. So that's basically what we mean by, in this case, what? 70% of the net assets and 30% of the net assets. So if in this case, the company is having to control 70% of the net assets, the remaining net assets will in this case be in the hands of what? The NCI, or the non-controlling interest. So that's basically in this case what we mean by that. That's in this case what we mean by that. So I want us now in this case we move to the next step, or maybe in this case section, we can be able to start the next section. So that we can be able to see, when you are preparing the consolidated financial statements, what are the key entries that you must be able to mark how they are supposed to be treated. So in this case, you can be able to write treatment of special transactions in consolidation. Treatment of special transactions in consolidation. Treatment of special transactions in consolidation. So the first special transaction in this case I want you to write is what we call intergroup sales. And unrealized profits on closing inventory. So in this case, you can be able to write number 1, intergroup sales. And unrealized profits on closing inventory. Intergroup sales and unrealized profit on closing inventory. So what I mean by intergroup sales is, for example, if a member of the group sells goods to another member of the group. Like in this case, if you have a subsidiary that has maybe sold goods to this one, or maybe this one has sold goods to this one, how do you treat that kind of a transaction? So you write this. Intergroup sales occurs where a member of the group sells goods to another member of the group. Intergroup sales occurs where a member of the group sells goods to another member of the group. Hope you've been able to write that. You need to be very keen. From this particular point in time, you need to be very keen as to what you're having to say. So you're having to say This occurs where a member of the group sells goods to another member of the group. This occurs where a member of the group sells goods to another member of the group. And of course, you'll be able to say, when you talk about members of the group, we're talking about what? Either the holding company, in this case, the associate, maybe in this case, it could be the subsidiary, so like that. If in this case it happens, then what will be the treatment of this kind of a transaction? You should be able to write full stop. So this occurs where a member of the group sells goods to another member of the group, full stop. Full stop. So this is how you treat this kind of a transaction. So after just that full stop indicator, the intergroup sales are normally eliminated as follows. This statement, allow me to say, it is a master statement. It will never miss in any question. In this case, you have to write, the intergroup sales are normally eliminated as follows. The intergroup sales are normally eliminated as follows. So in this case, you say debit the sales account. In this case, you credit what? You credit the cost of sales. In this case, you credit, in this case, what? The cost of sales. You credit the cost of sales. You credit the cost of sales account. You credit the cost of sales, in this case, what? Account. So in this case, what will be happening? What in this case will likely be happening? In the question, you'll likely be given something like this. You'll likely be told that there are two financial statements. So in this case, they'll say there are two income statements that will be given in the question. We have in this case for the parent company, and we have in this case for the subsidiary, which is company B, for the subsidiary. So you'll likely be given here, you'll be told sales. Sales, for example, in this case is actually, for this one is 1,000. And for this one is actually maybe 2,000, just assuming it's actually 2,000. Then you'll be told cost of sales for this parent company is actually maybe 400. For this one is actually maybe in this case what? 800. And then in this case, it means when you do that, you should be able to get the GP. So of course, you'll be given the GP and everything down there. So this one is having to give you 600. This one is having to give in this case what? 1,200. Is having to give in this case 1,200. So now in this case, what will happen in the additional information, this is what they'll be able to tell you. They'll tell you in this case, for example, maybe B sold goods to A, or maybe A sold goods to B. What? Maybe in this case, what? 60. Maybe in this case, how much? Maybe let's say, for example, in this case, 60. So they can be able to tell you something like that, because that's what an intergroup sale means. That, you know, you've been given the question, the two financial statements, the income statements for the two companies. So they are just line by line. And then in this case, you are told sales for this one is 1,000 and this one is 2,000. Cost of sales is 400. The cost of sales of this one is 800. So of course, you'll be able to get the GP and the other items down there. Now in the additional information, they'll say, for example, additional information number 1. A Limited sold goods worth 60. So in this case, what? B. So what you're having to say in this case, you need to do what? Eliminate. You need to eliminate them. In short, what you're having to say, you need to deduct this amount of 60. You need to deduct from the sales, and also deduct from, in this case, what? The cost of sales. This will likely be able to adjust. And then in this case, what will be happening? You know, when you are consolidating, it means you are combining the books of accounts. And therefore, in the consolidated income statement, what is going to happen? You'll be adding the two items line by line. You'll be saying sales. Now you are coming up with the answer. You'll say in this case, sales will be 1,000 plus 2,000, but now we minus what? 60. Then in this case, you'll be able to say cost of sales is equals to 400 plus 800, but now we minus what? 60. You eliminate them, the intercompany sales. You have to eliminate them. You eliminate them. And in this case, it means what you're having to do here, when you deduct the 60 here, you are debiting sales. When you deduct 60 here, you are crediting what? The cost of sales, because this one is an expense. When you reduce an expense, you are basically having to credit it. When you increase an expense, you are debiting it. And therefore, if there's actually an intergroup sale where a member of the group sold goods to the other member, you have to deduct from the cost of sales, and also in this case, what? From the sales. So like that. That's what will happen. That's how the question is normally framed. In the question, you are given the income statement line by line for the two companies, the parent company and the subsidiary. Then you are told that B sold goods worth 60 to A. So when you're consolidating now, you're coming up with the other. To consolidate, you're having to say you are doing what? You are coming up with a single income statement for the two. And therefore, you need to add the items line by line. But now in this case, you have to consider what? These kind of adjustments. So if in this case, there was an intercompany sale, it means you just add line by line, 1,000 plus 2,000. But now you eliminate it, you deduct, because that's the requirement. Then in this case, also you do what? You deduct from the cost of sales. You eliminate both sides. You actually, in this case, eliminate both sides because it was a transaction within the same member of the group. You are selling to the same member of the group. So it's not a sale outside what? The group. So that's basically what will likely end up having to happen there. So once you look at, in this case, an example, you're going to see. But in this case, write further, just write further first of all, about this kind of a transaction. Just write further and actually be able to say. So now in this case, you have seen the first part, which in this case is that what? An intergroup sale. You eliminate it by having to do what? Debit the sales account and credit the cost of sales account. Put in bracket minus. This will help you to remember. You deduct, you eliminate by having to do what? You deduct from the sales, and you eliminate by having to deduct from what? The cost of sale. You can put in bracket like that. So it will help you to be able to remember very fast. Be able to remember very fast. This is the second part here, which you are calling what? Unrealized profits on the closing what? Inventory. Unrealized profits on, in this case, what? The closing inventory. So you can write this. If the goods sold to a member of a group at a profit, if the goods sold to a member of a group at a profit, if the goods sold to a member of a group at a profit, remain in stock at the end of the financial reporting period, if the goods sold to a member of a group at a profit remain in stock at the end of the financial reporting period, is it just goods or services? So I can tell you it is both of them, but now in this case, in the past papers, there is no service that you'll come across in the question. They'll tell you goods. They'll tell you what goods. They'll tell you goods. Look at all the past papers. There's none in this case. They're talking about services. So don't start confusing yourself with the services. Go with the term goods and you go with it up to the end. Go with the term goods up to the end because you'll never come across services in the past papers. Go with the term goods and ride with it to the end. So write this. If the goods sold to a member of the group at a profit remain in stock at the end of the financial reporting period, if the goods sold to a member of a group at a profit remain in stock at the end of the financial reporting period, it will give rise to unrealized profit on closing inventory. So if the goods sold to a member of a group at a profit remain in stock at the end of the financial reporting period, it will give rise to unrealized profit on closing inventory, or we can say closing stock. So if the goods sold to a member of the group at a profit remain in stock at the end of the financial reporting period, it will give rise to unrealized profit on closing inventory. Full stop. Then you write this. This is now the master statement, how you treat it. The master statement as how you treat that unrealized profit. Full stop, you write. The unrealized profit will be eliminated as follows. The unrealized profit will be eliminated as follows. The unrealized profit will be eliminated as follows. Also, you have to eliminate what? You have to eliminate that unrealized profit. The unrealized profit will be eliminated as follows. Then you put a semicolon. You say debit cost of sales. You will debit the cost of sales, or in this case, the retained earnings account, because it's a profit you've not realized. It's like an expense, and therefore it is having to do what? Increase your cost of sales. Or maybe what? You debit the retained earnings account. You take debit the cost of sales or retained earnings account, and you credit the closing inventory. You credit the closing inventory. You credit the closing inventory. You credit the closing inventory account. So it means you'll likely be able to deduct in the closing inventory, you'll be able to present in the statement of financial. So this one will likely be able to appear in the statement of financial position. So basically what is happening here, you are having in this case to do what? Deduct here. You are deducting But now here, because you are debiting cost of sales, you are adding. It is adding your expenses. It is adding your expenses. You are simply having to add your expenses. When you debit an expense account, it means you are increasing your expenses. But you know what is happening here? Your expenses are having to increase because you never realized that profit. It is still in the stocks. It has not, in this case, basically been sold. It has not actually, in this case, been done or been sold off. It is still, in this case, what within the members of what of the group. It's still within what the members of the group. It's still within what the members of the group. So then in this case, you write an NB just under that, write an NB just under that, and NB just under that. When determining the unrealized profit, it is important to differentiate between the margin and the markup. When determining the unrealized profit, it is important to differentiate between the margin and the markup. When determining the unrealized profit, it is important to differentiate between the margin and the markup. The margin and the markup. To differentiate between the margin and the markup. The margin and the markup. The margin and the markup. Then you say margin is equals to, you write a formula for the margin. Margin is equals to, how do you get the margin? You in this case end up having to take what? The gross profits of, in this case, what? The sales. In this case, margin is equals to GP over sales multiplied by 100%. And in this case, the markup is equals to, these formulas I'm writing, they'll come in handy. When now we start doing the questions, you realize why these formulas I'm having to write here are very important. Over cost of sales, you multiply by 100%. You multiply by 100%. You multiply by 100%. You multiply by 100%. You multiply by, in this case, by what? By 100%. Hope you've been able to write that. So margin, this is how you get it. GP over sales by 100%. Or the markup, that's how you actually end up having to get it. So you can, in this case, look at an example. Write an example. Just under that, write example. Write an example. Write an example. Oh, I don't know whether we'll be able to finish that example, but just write it. Write an example so that what you're having to say here, if it appears in the additional information, things might not end up having to go marambas, but now at least you'll be able to understand what is happening. Write example. Write an example. Then you write this, an example. A Limited controls 90% of B Limited. So A Limited controls 90% of B Limited. A Limited controls 90% of B Limited. That means in this case, what? A is our parent, B is our subsidiary. B Limited. Full stop. During the post-acquisition period, during the post-acquisition period, comma, B Limited sold goods to A Limited worth. B Limited sold goods to A Limited. A Limited worth shillings 120,000. Shillings 120,000. So that was what an intercompany sale, intergroup sale, worth 120,000. Reporting a profit margin of 20%. Reporting, just continue reporting. Reporting a profit margin. A profit margin. Reporting a profit margin. Reporting a profit margin of 20%. Of 20%. Of 20%. Of 20%. A profit margin of 20%. Assuming the goods were still in stock at the end of the year. Assuming the goods were still in stock, assuming the goods were still in stock at the end of the year. At the end of the year, assuming the goods were still in stock at the end of the year, assuming the goods were still in stock at the end of the year, full stop, determine the unrealized profits at the end of the year, determine the unrealized profits, determine the unrealized profits, and show the relevant entries, unrealized profits, and show the relevant entries, and show the relevant entries, and show the relevant entries, and show the relevant entries in the books of account, in the books of account, in the books of accounts, in the books of accounts, in the books of accounts. So we've been able to complete writing. I've moved through. You're having to write that admin. So Anne, are you through having to write that? Are you through having to write that or not yet? Are you through having to write that or not yet? I can see Calvin says yes. GK. Ezra, yes. James, yes. So in this case, that's what they're having to say there. So these are basically what you actually do, because there are two things happening here: an intergroup sell and an unrealized profit on the closing inventory. So these are how you could have actually been able to deal with these entries when you are finalizing your accounts. So to eliminate the intercompany sell, so first of all, number one, to eliminate the intercompany sell, so you're having to say, you likely end up having intercompany sell of shillings 120,000. In this case, you're having to say, this is what you'll do. You likely debit the sales account with, in this case, what, shillings 120,000. Or in this case, what is having to happen here, you are deducting from the sales. So you deduct in this case from what? From the sales. You'll minus from the sales that you have. In this case, then you likely end up having to credit the cost of sales. The cost of sales, within this case, still what? The shillings 120,000. Ideally, what these entries are having to mean, because these are an expense account that you are crediting. When you credit an expense account, you ideally deducting that expense. And then in this case, you'll say, you deduct from, in this case, what? The cost of sales. You will be deducting from the cost of sales. You will be deducting in this case from what? From the cost of sales. From the cost of, in this case, what? Sales. Then in this case, you write, to eliminate the unrealized profit on the closing inventory, to eliminate, number two, to eliminate the unrealized, because you're having to say that's how you treat unrealized profit on closing inventory. So they sold to a member of the group worth 120,000, but these goods, they are still in stock. That member of the group has not disposed them off. They are still in the closing stock. So they have not actually been able to realize a profit out of what these goods. So this is what unrealized profit on the closing inventory. So to eliminate the unrealized profits, on the closing inventory, to eliminate the unrealized profit on the closing inventory, to eliminate the unrealized profit on the closing inventory, So in this case, you are supposed, in this case, to do what? To calculate it. So in this case, the unrealized profit, so the URP, in this case, we normally call it URP. So the URP is equals to the unrealized profit. You have to take what? The profit margin. And in this case, you multiply by what? By the sales. So the profit margin, in this case, you multiply by what? By the sales. So in this case, the URP is equals to the profit margin. You multiply by the sales. And that in this case, it will likely be equal to what? You've been told it was likely what? 20%. 20% multiplied by 120,000, which was the sales. In this case, 20% multiplied by 120,000, which in this case is equal to what? 24,000. is equal to 24,000. So these are basically you get what the unrealized profits. So you're using the margin. So the profit margin is actually what 20%. The profit margin multiplied by what? By the sales. So in this case, we likely end up having to do what? You debit the cost of sales or the retained earnings. So I don't know whether you'll be able to see there. So let me wrap here. We wrap here so that you can be able to see. Hope you're able to see there. You in this case debit the cost of sales. You'll debit the cost of sales. So cost of sales will start getting used to call it like this: the COS or the retained earnings account. The retained earnings account with what? The shillings, 24,000. The shillings 24,000. You know, when you don't realize a profit, that's like an expense in the business. You are suffering. You are supposed to have realized it, but you haven't realized. You are suffering because you've not realized it. It's like an expense. And therefore, in this case, what is happening here, you are adding to the cost of sales. You're really adding to the cost of sales or what? The retained earnings. When you talk about debiting an expense account, you are adding. When you talk about debiting a cost of sales here, you are it is increasing this expense. When you debit an expense account, you are increasing. And therefore, in this case, we are adding. It's important you master this because this is the language you'll get used to. We'll just go to the cost of sales in the income statement, then we add that unrealized profits. You'll start asking yourself, why are we adding? Why are we adding? It's because it's the same language you're having to say what? Debit the cost of sales. Then in this case, you're having to say you credit what? The closing inventory. The closing inventory. We credit the closing inventory with what? The shillings, 24,000. So in this case, it means you're having to do what? Deduct. When you credit an asset account, you are reducing it. And therefore, in this case, we'll be minusing from what? The closing inventory. So this one appears where? In the consolidated statement of financial position. So we'll take the closing inventory of the parent, we add on to that one of the subsidiary, then we minus the URP. This is what will be happening. This is what in this case will likely be happening when we are doing what they call consolidation. The consolidation. So that's just in this case one of the key entries. So let's end there because time is not on our side. So you can see already the other class is almost having to start. So we'll move in this case to another example. We look at example 2. Then in this case we'll be able to look at other entries. Maybe hopefully tomorrow we'll be able to start with the first illustration. The first illustration. So let's end there for now. So you just be able to capture what you've been able to learn. So let's end there for now. Unless there's a question you can be able to ask. But let's end there for now. So we'll meet tomorrow and continue with the other entries, other special transactions. Yeah, I can see your comment there, Evans, GK, yes. So see you tomorrow. Same time. We'll be able to pick up from there. Have a good night. Felista, if given markup how to convert, don't worry. You just wait to be able to have a look at it. You first of all grasp margin. We look at markup conversion.